For more on this, let's bring in the president and chief information officer of Lebenthal Global Advisors, Dominick Tavella. So we're going to get into those uninsured customers, depositors in a moment. But what went wrong, Dominick? Why did this happen?
Arthel, it was almost literally the perfect storm, unfortunately, for Silicon Valley Bank. A combination of, they had a very concentrated number of clients, as your reporter mentioned, in the Silicon Valley area. So it was Bitcoin and Coinbase type investments. It was startups. It was venture capital. And over the last 12, 18 months, they've been burning through cash very aggressively. The market environment, their ability to raise additional capital. So they were withdrawing at an accelerated rate. Probably most harmful, the bank itself had 60% of its deposits in fixed maturity bonds. And as many investors learned last year, when interest rates go higher, when the Fed raises interest rates, the value of those bonds went lower. So as demand for cash came out, they were forced to sell those bonds, $21 billion worth of bonds, at almost a $2 billion loss. So those two big issues right there.
Yeah, so here's a question. Should the U.S. bail out SVB or the uninsured depositors, the customers who stored more than $250,000 in that bank?
Yeah, Arthur, we have two questions here. One is the investors, the shareholders, the people that invested in this bank, hired management, have a board that is supposed to oversee how the bank is run. And I'm sorry, those people made an investment, maybe in hindsight a bad one. I don't think, especially the U.S. taxpayers, should be in a position where they're protecting the investors. On the other hand, the depositors, I think, have a legitimate gripe here. They're trying to meet payroll. They have investment cash flow needs that they need to make. I think the government should help another bank come in and acquire Silicon Valley Bank and assist the depositors in getting their cash flow and their money back.
Well, this all brings back nightmares from 2008 during the housing market bubble. Bear Stearns, stock nosedive, 50%. Lehman Brothers collapsed. I mean, we could go on, but is SVB an isolated event, or is it contagious?
Well, the thing that caused it in itself is not isolated, and this is the Federal Reserve raising interest rates and making the value of these bonds go lower. If you're able to hold these bonds to maturity, you're going to get your money back. But if you need to liquidate them and liquidate them quickly, number one, you're going to sustain a loss, and then that amount of bonds hitting the market at one time, whoever bought them, I promise you, got the bargain of a lifetime. So most banks out there own these bonds in their balance sheets, but they also own mortgages. They also lend out for car loans, business loans, credit card balances. They have a more diverse portfolio. So even though banks, insurance companies, pension funds, we're all dealing with the same problem, the valuation of our bond portfolio, by having a diversified portfolio that can soften the blow, and the management of those bonds can soften the blow. Unfortunately, Silicon got caught looking the other way and in a position where they had this huge run for cash in a very, very short period of time. They couldn't solve the problem.
Yeah, because there were a lot of startups doing banking there. So where did those startups go?
That's the problem, right? So the significant number of the depositors were businesses, startups, again, technology companies. They usually, and I mean burning through cash, because in the early stages of these companies, you're going through cash because you're trying to get an idea, a product up and running and eventually out to the market. So they need that cash flow. And that's why I do think that the government should encourage another bank to step in, help take over these assets, manage the portfolio out. And I think in the end, most of the depositors' money can come out safely. And I remind you, Arthel, that over a 2-3 day period, over $40 billion of depositor money was withdrawn. So a lot of this money did come out, but unfortunately, some investor money, some depositor money is still sitting there.
Yeah, a run on the bank for sure. Really quickly, though, I want to squeeze this in. Generally speaking, Dominick, if you have more than $250,000 of working capital, you know, that money you need to access, what should you do?
Well, the $250,000 applies per registration, so a husband and wife theoretically could each put $250,000. They could also do a joint account, and that also gets a little wonky about how it gets split. But you can use multiple financial institutions, so you can go to different banks. But if you're a large corporation, it's kind of hard to function and operate this way. So you literally could set up, and we do it for our clients, where you set up a segregated account and you buy direct Treasury bills and notes that mature on a specific date. So cash flow management is part of the job of running a company, mine included. How this happened, I think there'll be books written about it.
I'm sure you'll have a book coming up on this particular topic yourself. Dominick Tavella from Leventhal Global Advisors, thank you for joining us. I'm sure you probably already have books. Do you have books already? Before I just go away and just say you're going to have
No, I don't, but I have gotten many a phone call this weekend. Do we have any exposure? Do we have any involvement? And many an email from outside firms that we work with attesting to that they don't have exposure. So clearly there's a worry in the market about this, and I think it'll settle down, it'll calm down, but we might have a few days of volatility.
Uncertainty. All right. Dominick, thank you.
Thank you.